Okay, this is a very rough overview of some of my research on Alibaba, which trades on the U.S. exchange as Baba. Okay, Charlie Munger invested 20% of his daily journal fund in it just recently, well, this quarter. We just found out about it, or it's just been reported in the last few weeks, last week. The forward PE is somewhere between 1 point, I'm probably PE to growth, PE to earnings growth ratio called the PEG. Lower is better, below 1 is very good. Bob is at a 1.9. Depends on how you calculate it. When I calculate it with non-GAAP earnings and use the forward earnings per share number, in other words, the 2021, I got a 1.56, which is pretty good. But it's a growth stock, so I'm okay with it. Maybe not being a peg below 1. I used Hamish's spreadsheet and came out with an estimate of a 10% rate of return based on 14% free cash flow growth, which is close to the earnings per share growth. We'll get to that below, and it's pretty close to the free cash flow growth. And 14% is not amazing, but I, I think but I think that's good enough for me. It's trading below at 28% below its fair value. This is according to Simply Wall Street. I don't have a screenshot of that, sorry. Fast Graphs, which I use, said it's trading below its recent PE and intrinsic value. I don't know if you know much about Fast Graphs, but basically they look at what they think the intrinsic value is based on the earnings per share, and that's this orange line. The green line is actual earnings, cumulative earnings, and the idea, and then the blue line is the price that it would be at now based on its earnings if it were being valued at the same PE that it's been valued at over the range of this graph. So it takes the price earnings multiple for this whole area, this whole range, date range. It averages it and then says, okay, what would the price be on this date based on the earnings? And if you had looked at this blue line, you would see that the PE ratio is the same all along that blue line. So then what happens is the price sometimes is below that, and sometimes it's above that. Above that. So when the price is above that, then the stock has a PE ratio that's lower than the average for this whole area, than the blue line. And then when it's below it, it means that the PE is below that average. So low PE means, arguably maybe it's a buy right now. Now, more important is this orange line, which is their calculation of intrinsic value based on earnings. And the idea is that the price is going to tend to follow the the blue line and the orange line. And here we can see it kind of does that. So, and the idea is that that drives the stock price. If you're a value investor, that's kind of how you view things. Um, and so the idea is right. And then the light green is future predictions. So they're predicting that earnings are going to do this. Um, and the price dropped off probably because they were fined. Fine really wasn't that big. We'll get to that in a minute. So this is fast graphs, which is kind of cool. And then you can also do the same kind of graph now that was non-GAAP earnings, which leaves out one-time expenditures and things. So maybe it's a little bit more accurate, but GAAP maybe is more rigorous. But even under GAAP rules, we're seeing something very similar, which is that the price has gone down while earnings have gone up, are going to keep going up. Okay. So, and we could also look at that for cash flow, but I'm not going to, I'll show you this so you can look at it later. Cash flow is doing something similar. And the idea is that ultimately cash flow, or more specifically, free cash flow is what we're buying as value investors. Okay, so next, earnings are forecast to grow 13% per year, revenue growth 18%. My calculation, very, very rough, of free cash flow growth is about 12 to 15%. And these are all cumulative, what's the word? Compounded annual growth rate, sorry. Um, and we'll show this real quick. And again, I took this uh, from Simply Wall Street, which is really good. So I just kind of did a rough calculation of what their cash flow, their free cash flow is doing. So free cash flow is growing at about 12 to 15%. I also looked at the accuracy of analysts here, and I did this through Fast Graphs, but there are other things that do it as well, other resources. So basically, if we look out at 2 year projections, they meet estimates 2 years out with about a 20% margin of error all the time, 100% of the time. If we go out only a year with our estimates, but only give them a 10% margin of error, they meet it about 80% of the time. And you can use this analyst scorecard to kind of see what I was talking about. So this is 2 year projections, and this orange shaded area is the margin of error, and the orange line is the actual performance, and the dashed line is predictions. So you can see here in 2018, they were above the prediction, so they overperformed. In 2019, they underperformed, and in 2020, it looks like they were spot on. So again, 2 years out, they stay within that shaded area all the time. And then 1 year out, we can see that in 2019 they underperformed, so they missed 1 year. But every other year they've met or exceeded, or they've met within tolerance or exceeded. Okay, and then I just summarized this. They meet analysts' EPS estimates 80% of the time for 1 year. And 100% of the time with 10% margin of error, and 100% of the time for 2 years. So bottom line is their analysts or projections are pretty reliable or dependable. Management seems good, and Hamish suggested looking at debt to equity, and they are growing equity, and debt is actually going down a little bit. So just fantastic there. Okay. Let's see. And we already covered free cash flow and per share growing. Revenue now another point is that revenue now is 30% higher than the last time it was at this price. And again, all these numbers are as of yesterday. Unfortunately, I have not altered my analysis, but I didn't get to look at this I didn't get to record this until today. Last time it was at this price was May of 2020, when it had 548 something Chinese currency and revenue. And then, but you can see all those numbers there. But I also did a graph here so you can see where their revenue was. And, well, it doesn't have vertical numbers on it because of the way the graph works. So sorry about that. But you get an idea of how much the revenue has been growing since the last time it was at this price. Just phenomenal. So it grew from there till about here, and now it's at the same price it was then. Okay, so next, and some risks. Oh, and some tailwinds. Chinese economy is growing, has 41% of global growth in 2019 and 2021. Here's some quotes on that. You can read that if you like. I'm not going to go over it. And some risks. BABA was fined for anti-competitive behavior. However, that's only 10% of their free cash flow for 2020. By the way, the fine didn't hit till 21, so it's really even lower percentages than this. So I'm not too worried about the financial impact. And the reality is, sadly, if they can get away with anti-competitive behavior, it makes the company more successful. So It's sad, not that I want to make money that way, but one man's anti-competitive is another man's really successful capitalist. The Ant IPO was delayed. There was a company that Alibaba owns 33% of. They paid about 20 billion for it. It's going to IPO at 300 billion, which would have been a 5x gain for them. But the Chinese government interfered with that, put some restrictions on it. I've seen some analysts, some articles saying, "Oh, it was quite reasonable that the government delayed it." It's possible that, or likely that it'll be just delayed, but the company might be modified to meet those rules, so that which may cause the company to be less profitable. So the Chinese government may put some restrictions on them that cause them to be less profitable. However, I would point out that that the spinoff, while it's a lot of money for Alibaba, isn't actually reflected in their current financials. So everything we looked at above is not, as far as I know, not assuming this IPO, because there's no way they could, because they didn't really, they thought it was going to go at 300 billion, but that's not guaranteed. The other risk is that BABA is an ADR. I forget what that stands for. It's like American shares in a Chinese company, and arguably the Chinese government could just decide, oh, we're not going to respect that, and that's now state owned. I think that's unlikely. That would be really foolish for them to do. It would cost them, oh my God, probably trillions of dollars in non-Chinese and foreign capital. And what China really wants, well, I think China wants people to invest, but that's my opinion. Okay, some supplemental info. This is a really good Seeking Alpha article that you might check out, kind of about whether you want to invest in them now. And again, they show the PEG, just FYI, as 0.85 now, but I don't know how they're estimating that. And again, that's PE to earnings per share growth. A lower number is better. The nice thing is it includes current PE ratio and future projections together in one number, because you could have a company that has a really low PE, but its growth rates suck. Or it could have a really high PE, but it's got phenomenal growth rates. I'd rather invest in a company with a 30 PE that's growing 30% a year in earnings, rather than a 10 PE that's stuck at flat and not growing at all. So uncertainty has created buying opportunity. Um, can read some more here about this. This is where they talk about the Chinese government is growing. Chinese business is growing really fast. Talks about their Alibaba's growth from the Alibaba reference material. So, they may be biased, but let's assume they're being honest, though. Be dangerous for them to publish false information. Um, yeah, so they're huge, and they have a dominant position, yet they're still growing. They're acting like a growth stock, which is really appealing. To get a company that big, that's dependable. I mean, you're basically getting to buy Amazon, but with 30-40% growth, which is just amazing. So anyway, that's all I've got to say on that. Love to hear feedback.